So let's continue our journey through macroeconomic analysis with a reading on monetary and fiscal policy. We have about 17 learning outcome statements here, which sounds like a lot, but is not a terrible amount because a lot of it's just definitions and things you need to memorize. So easy to present, harder for you. Not too much analytical in here. So let's jump in and first off just define what we mean by monetary and fiscal policy. Now, monetary policy, management of the supply of money and credit. We've talked about this in other study sessions so far. When we talk about an expansionary monetary policy, we mean the money supply is getting bigger, or sometimes we mean the growth rate of the money supply is increased. So you may see it either way. So if we increase the money supply, that tends to decrease interest rates, which tends to increase aggregate demand. Remember, C and I in C plus I plus G plus net exports both increase. Contractionary monetary policy, just the opposite. When it's time to fight inflation, slow an expansion down, that increases interest rates, slows down business spending, slows down economic growth, and hopefully tames inflation. So that's monetary policy. On the other hand, when we talk about fiscal policy, we're talking about government taxing and spending. So an expansionary fiscal policy could be if the government increased spending, holding taxes the same, or decreased taxes, holding spending the same. Now what I want you to focus on when we're trying to identify expansionary fiscal policy is usually the budget deficit. So increasing spending with taxes the same could increase the deficit, or holding spending the same and decreasing taxes to stimulate the economy and spending, that's going to increase the deficit as well. Contractionary fiscal policy, on the other hand, just the opposite, either decrease spending or increase taxes, or both, to decrease the budget deficit. The idea is to reduce aggregate demand. So, whereas with monetary policy, we were really focused on the C and the I, the consumption and investment spending by businesses in aggregate demand. Here, we're focused on the G with the spending, but the other side is the taxation. And as we'll see, taxes are going to affect disposable incomes, and that's going to affect consumer spending as well. So, this learning outcome statement, what are the functions of money? It's a medium of exchange. We use it to do transactions. It's a unit of account, and it's a store of value. If I spend less than I make, I can put it away for retirement or other future needs. And I guess we all understand this is more efficient than a barter economy, so nothing too rough right here. Now, when it comes to defining the money supply, in general terms, we've got what is called narrow money and broad money. So, narrow money, and this goes back to a time when checking accounts didn't pay any interest. So we're really talking about money that doesn't pay interest and money that does, if you think about it that way. So in narrow money, and this is what's called M1 in the US and the Eurozone, we've got the actual currency in circulation, we've got checking account deposits, and we've got traveler's checks. So that's our narrow definition of money. A broader definition includes all of these, so broad money includes M1, or narrow money, and also includes savings deposits, time deposits, CDs, and money market mutual funds. So that's our broader measure. Okay, where's my button here? And we'll jump ahead. How banks create money. Now, you may have to look at an example and work through an example of this to convince yourself that it really works, but the story is pretty straightforward. In a fractional reserve banking system, deposits are made into the banks, and what do banks do? Well, they lend out that money, in a simple example, to earn some interest, and then they pay interest on their deposits of some sort or another. So the required reserve ratio says, well, how much of deposits does a bank have to keep and how much can they lend out? And That's probably about 20%. It's different for different accounts. It's different over time, and it's different across countries, but this example will serve us pretty well. So $1,000 in new reserves come into the bank. The bank can loan out 800 of that when the reserve ratio is 20%. So 1,000 comes in, they lend 800 out. Well, the story is that 800, let's say it gets deposited in another bank. Well, that bank can loan out 80% of that, or $640 in new loans. And then we can take that, if that is deposited in full, the banking system could create another $512 in loans. So the potential at the end of this process, or in the limit, is that injection of $1,000 into the banking system actually could create potentially $5,000 increase overall. So our maximum deposit expansion multiplier here is just 1 over the reserve ratio, which is 5. Now remember, this is the potential, right? If of that first $800 loan, some of that didn't go back into the banking system, but was put under the mattress, let's say, then this potential is not going to be reached. So that's kind of the maximum. So think of it that way. Okay. What are the various types of demand for money? Well, transactions demand, demand for money to do your business, get it done. Well, that increases with GDP. So at some point we're going to say, well, what are the factors that increase the demand or decrease the demand for money? One of it is overall GDP. In order to transact more in terms of goods and services, there's more demand for money. Pretty straightforward there. We also have a precautionary demand, money held for unforeseen future needs. That also increases with GDP. And our third type of demand for money is speculative demand. That is, it's being held to take advantage of future investment opportunity. Now, when current returns are high, not so much money, remember we're thinking of this money as narrow, non-interest bearing money, is smaller when the returns on potential investments are higher. And it's greater when the risk is perceived to be high. So markets look very, very risky, more money is held in cash. Now, on the other side of demand for money is the supply for money, and supply of money, and we're going to treat this as being set by the monetary authority, the central bank. We usually draw it as a vertical line, right? A fixed supply determined by the monetary authority. So that's what we'll be using in our analysis here. So here is our equilibrium in the money market story. Well, the interest rate here on the y-axis, that's the price of money. That's what you're giving up to hold this non-interest-bearing cash, traveler's checks, checking accounts. And how does this work? How do we get to equilibrium? Well, at this higher interest rate, you see there's an excess supply of money. So people are holding more money than they're willing to hold at that higher interest rate. So what happens? Well, they try to get rid of this money. How do they get rid of it? Well, these high interest rates cause them to, let's say, buy bonds, buy interest-bearing securities. Well, as they buy interest-bearing securities, trying to not hold as much money because of the high interest rate, this drives the prices of those interest-bearing securities up, and that drives interest rates down, right? Bond prices higher, interest yield lower. And so that's how we get to equilibrium here. Now, on the other side of that would be an interest rate that is below equilibrium. Well, in this case, there's excess demand for money. Well, how do people get more money, right? The interest rate is low, So the opportunity cost of holding money is lower. The opportunity cost of not being invested in interest-bearing securities is lower. So in this case, they try to raise more money and they sell interest-bearing securities. The sales of interest-bearing securities drives their prices lower, and that increases the yield. So that's our very simple story of equilibrium in the money market and how we get there. So remember, interest rates on the y-axis and the real money supply here, so we're ignoring price level changes, real money supply on the x-axis. And here we are back at equilibrium. Next term you have to know is the Fisher effect. Irving Fisher, famous guy, wrote back in the 30s, great economist. He came up with this idea that the riskless nominal rate of interest, that's like a T-bill rate, right? Riskless nominal rate of interest, has two components. The real riskless rate and expected inflation. Remember that real rate is how much more stuff can I get later? So if the interest rate nominal is 5% and expected inflation is 3%, then the real rate is approximately 2%. Because if prices go up 3% and you have 5% more money, how much more stuff can you get? Well, you can get 2% more stuff. And so that's the Fisher effect, or the Fisher equation. Now, there's some uncertainty about future inflation rates, and there may be a risk premium in there too. That wasn't part of Fisher's original argument on this, but it's something you should understand. So we can modify this Fisher effect to say, well, the riskless nominal rate has three components: the real riskless rate and expected inflation. Now, if expected inflation were known with certainty, then this first Fisher effect equation would hold. But if there's uncertainty about inflation, then that puts another risk, right? Purchasing power risk. Uncertainty about how much stuff you're going to be able to get at the end of the period, or how much more stuff you'll be able to get at the end of the period. And so we add a risk premium on that for uncertainty. And we don't deal with this too much at level 1, but just something you should be aware of. I can get this. Okay, now let's start to talk about central banks and how they manage the money supply. What are the roles of a central bank like the U.S. Federal Reserve? Well, they issue the currency. Okay? They're the banker to banks and government. They hold the reserve deposits. Remember our reserve requirement? Okay. They regulate the banking industry and the payment systems, not completely. There's other agencies that do this, but they do have some role in regulating the banking system. They are, as we saw in our most recent financial crisis here some years back, lender of last resort. They were the ones that were bailing out the banks. They were the ones that were bailing out these other companies that were overexposed and on the brink of financial collapse. Okay. They hold some gold and they hold foreign currency reserves, but that's not the main thing they hold. Okay. They also hold treasury securities, and they conduct monetary policy. So we'll now turn our attention to how they do that and what they're trying to achieve. So let's take a look here at the objectives of central banks. All central banks have some sort of price stability, right? We've got fiat currency. The central bank is in charge of the money supply, which means they can essentially print currency or reduce the currency in circulation. So all these central banks that have this power have a mandate of price stability. Don't print so much money that you get into high inflation and unacceptable levels of inflation. Now, many have explicit target rates. The U.S. and Japan don't, but most do. Most central banks have an explicit target rate, usually 2 or 3%. Reason it's 2% is because, as we mentioned in an earlier session, deflation is to be avoided. Central banks don't want deflation. So they set the target above 0. So that's why the target isn't 0. If the target were 0, I guess we'd be above it sometimes and below it sometimes. And so this is thought to be some sort of an optimal target rate for inflation. Now there may be other mandates that the central banks are given, depending on what country we're looking at. Maybe to maintain full employment and promote economic growth, which are very similar. Might be to keep exchange rates stable, but that's not as prevalent as it used to be. And in the case of the U.S. Federal Reserve, there's some wording in there about long-term interest rates being moderate. Well, if we think back to that Fisher equation, interest rates equal the real rate plus expected inflation. One way to keep long rates under control is to keep inflation under control. So those kind of go together. But some of these goals may push in opposite directions. If the goal is to maintain full employment, but you've got too high inflation and your goal is also to moderate inflation, well, decreasing the money supply certainly can rein in inflation, but it's not clear at all that that would promote or maintain full employment, as we'll see when we get further into the analysis here. So those are the objectives, mostly inflation rate targeting. Now, we can talk about inflation as either being expected or unexpected. Remember when we were talking about that Fisher equation, I said, well, if inflation was known with certainty, then there wouldn't be that inflation risk premium in there for uncertainty about the real rate that investors are going to earn over the horizon. So expected inflation does increase the costs of holding money, and it adds some costs of changing advertised prices. But unexpected inflation has more of a profound effect on the economy. One thing it does, it shifts wealth from lenders to borrowers. So let's take a minute on this. This is an important point for you to understand. Okay? So I go out and buy a house, and I put 20% down, and I buy a $300,000 house. So I put $60,000 down, I borrowed $240,000. Well, over time, if there's inflation, so let's take an example of extreme inflation. Let's say the inflation is 100% over some period while I'm still owning this house. Well, those dollars I'm going to pay back my mortgage with are less valuable. And yet, if that's a fixed rate mortgage, my payments are set out 30 years. So the house is becoming more valuable, but my payments are easier to make. If we had 100% inflation, even if I didn't get a raise, I'd be making twice as much money if I was just earning the same in real terms. So now it's much easier to pay off that debt. So there's a shift from lenders to borrowers. Also, when there's unexpected inflation, supply-demand information and price changes becomes less reliable. So I've got a product out there, I'm a producer, and I see that prices are going up. People are willing to pay more for my goods. Now, if I don't think this is inflation, or I don't understand well that this is inflation, I may think people are really starting to love my products more. And I'll make the production decision to expand production. And so with this unexpected inflation, the price information I'm getting from the market may be misleading, or certainly, as it says here, less reliable. And so we have less stable business cycles and less good or incorrect production decisions by firms. So make sure you understand the implications of perfectly anticipated or expected inflation, which is not too bad, right? In the 2 or 3% area, if we know exactly what it's going to be, it doesn't impose a lot of costs. But unexpected inflation does this wealth shift from lenders to borrowers, and not just homeowners, right? Other lenders are people that buy bonds, and the borrowers are the issuers of the bonds, well, they can do pretty well with inflation too. Because with 100% inflation, their profits would double, it's easier to pay their debt, and the purchasing power of people who own bonds goes down because of the inflation. So that's the wealth shift. What are the monetary policy tools? Well, the policy rate, the interest rate central banks charge banks for borrowed reserves. Right? If a bank's loans are high and they don't have enough reserves, or they want to make more loans, they have opportunities, they can borrow reserves from the central bank. Now, they don't like to do this a lot, and if we see in the third bullet point here, the U.S. Fed sets a target for the federal funds rate. So sometimes that's the headline, right? Federal funds rate cut to 0.25% or 0.5%, whatever the target might be. And that's a market-determined rate, but the U.S. Federal Reserve can expand the money supply, increasing the reserves that banks are holding, and that encourages them to lend to other banks and brings this federal funds rate down. So this policy rate is a very short-term rate for borrowing by banks. So raising that policy rate discourages banks from borrowing reserves, makes reserves less plentiful and more expensive, and so that reduces lending and shrinks the money supply. Now, decreasing this discount rate or the Fed funds rate, overall thought of as a policy rate, would tend to increase the amount of lending in the money supply. If you make reserves cheaper and easier to get, banks are going to be more willing to lend. At least that's the story. We'll talk about some of the limitations on that story in just a minute. So that's the number one tool there, is this policy rate. The other two ways that they manage the money supply is through open market operations. Well, open market operations are going on all the time. And if they decide to change the Fed funds rate, they do this by increasing or decreasing the money supply. Well, how do they do this? Well, the central bank can go out and buy government securities. Remember, I told you that government securities are the main asset of the central bank. The currency issued is the liability. So the central bank buys government securities for cash. This puts cash out there, and the Fed holds the Treasury securities. This increased reserves, money supply increases. The other way around, the central bank wants to decrease the money supply through open market operations. Then they sell securities, and this takes money out of the system, puts it back at the Fed, and shrinks the money supply. The third tool that they can use is the required reserve ratio. Remember, our potential deposit expansion multiplier was 1 over that reserve requirement. In our example, 1 over 0.2 for a 5 as our potential deposit expansion multiplier. So banks can change that. If they decrease this percentage of reserves, the required reserve ratio, that allows banks to lend more and increases the potential deposit multiplier and increases the money supply. Increasing the reserve ratio has the opposite effect. Now, this is not an often used tool, but we've seen it used over the last few years. The Chinese banking system has adjusted their reserve requirements to make changes in the rate of growth of their money supply. So those are the three tools. What are the characteristics of central banks that we should look for? Well, I don't know if it'll help to memorize it, but if you look at TIC right here in characteristics, we've got transparency, independence, and credibility. I haven't got them in that order here. Independence, probably the number one thing that we look for in a central bank. Free from political interference. Well, certainly none of them that I know of are totally free from political interference. So at the bottom of this slide we've put this is not absolute. It's either up, they're not independent, yup, they are. But we look for a high degree of independence. And now we've got another definitions, or two more definitions for you here. Operational independence says they're free to set that policy rate on their own. And target independence, an example being the European Central Bank, sets inflation target, measures inflation, determines the horizon to meet the target. So, if the government is setting the policy rate, then they don't have operational independence. If the government is setting that target, maybe I said that wrong, the policy rate is operational independence. And do they also have target independence? So if the politicians, the governments are setting the inflation target and doing the measurement and all that, they don't have target independence and would have to set the policy rate to support the government target. But ideally, the central bank will have both operational and target independence. And the other two, credibility. A bank that doesn't follow through on its stated intentions loses credibility, and they're going to lose effectiveness. And transparency is a third characteristic we look for. The bank discloses the inflation reports, the indicators used, and how they use them. So if the banks do what they say they're going to do, if they say they're going to hold inflation to 2% and then follow through on it, these are going to be the most effective central banks. And with this transparency, markets start to anticipate what the central bank will do. If they know the goals, they know they're going to stick to the goals, and they've stated their policy and it's credible, then markets are going to anticipate what the central bank is going to do in response to deviations from this target rate of inflation. The better markets anticipate the action, the less disruptive effect the actions have when they implement them. Excuse me. Okay, so this part is important here. Monetary policy transmission. How does this work? How does it work its way through the economy? You say, well, we expand the money supply and people buy more houses. Well, how does this work? Well, when the central bank buys securities, so now buys securities, they're putting cash out there, taking securities back, so the money supply is increasing. This increases banks' reserves. This decreases that federal funds rate, or more generally, the interbank lending rate. So short-term and long-term lending rates decrease, especially if we think of the long-term rates as just having a liquidity premium, a maturity premium on them. Now, in response to that, businesses increase their investment. Money is less expensive, lower interest rates, lower borrowing costs. If I can borrow at a lower cost, there's other activities, expansions, business to be done that I can do at a lower cost that now looks profitable. So businesses increase investment. Consumers also are going to increase house, auto, and durable goods purchases because these are interest rate sensitive purchases. They're usually purchased on credit. So before, in an earlier session, we talked about, well, gee, if you expand the money supply, interest rates go down, C goes up, consumer expenditures, and I goes up, business investment goes up. Well, that's these two pieces right here. That's how a decrease in interest rates from an increase in the money supply can stimulate the economy. And remember, we said we would shift out aggregate demand, increase aggregate demand. So, another effect is that the domestic currency depreciates. Right? We've got a money supply, we've got a foreign exchange rate equilibrium, and now there's more money. Well, if there's more dollars, then they're worth less in comparison to other currencies. So this is why we say the depreciation of the currency. And also remember from an earlier lesson, this depreciation of the currency makes the domestic country's goods less expensive to foreigners. They buy more, and this increases exports. So now remember our aggregate demand. Okay, our aggregate demand, C plus I plus G plus net exports. Well, these are in C and I and net exports are all increasing because of this expansion of the money supply. So that's the transmission mechanism. So expansionary money supply affects four things. First off, market interest rates. Less incentive to save, right? Saving versus consumption, the higher the real interest rate, the more likely you are to postpone consumption now for consumption later, because the trade-off is, at a higher real interest rate, you're getting more stuff later from foregoing consumption now. Now, asset prices will increase. There's a wealth effect, so consumption spending increases. Expectations for economic growth increase, and in the economy, people may expect further decreases in interest rates. So that stimulates aggregate demand. Domestic currency depreciates, import prices increase, export prices decrease. So overall, we've got this increase in aggregate demand. That's going to increase real GDP, at least in the short run. And that goes along with increasing employment. But also this puts upward pressure on the price level, as we saw in our aggregate demand, aggregate supply graphs that we looked at earlier. Okay, central bank targets. Well, we've discussed this already. Let's flesh it out with a little more detail. Interest rate targeting. Increase the money supply growth when interest rates are above the targets, and decrease the money supply growth when interest rates are below the targets. Again, not a terribly complex idea, but certainly one that you need to have a good grip on. We talked about inflation targeting. Sometimes there'll be a band instead of a specific rate, and this band is typically 1 to 3% for the reasons that I talked about earlier. So, what does the bank do? Well, they increase the money supply growth if inflation gets below the target band, and decrease money supply growth when it's above the band. And the reason we have this band above zero is because we really don't want deflation. Now, inflation targeting is very prevalent, and that's really what the world of central banking has moved toward over the last decades. But there are some other targets that come up in special circumstances and that you should be aware of. One is exchange rate targeting. Have a target band for the exchange rate with another country, usually a more stable, developed country. And we sell domestic currency when we're above the target. That tends to depreciate our currency, pull it back down toward the target. Or we buy domestic currency when we're below the target. Now there's some limitations on how much domestic currency you can buy, because you have to have the foreign reserves to do this. So the central bank, when they have specifically exchange rate targeting, doesn't react to domestic economic conditions. So they're not looking at the policy rate. They're not looking at inflation rates. They're targeting the exchange rate. So what's the overall result of that going to be? Well, if they're successful, they should have the same inflation rate as the country with which they've targeted the exchange rate. So we're really just importing the inflation target of the developed country by targeting the exchange rate. right? If one country has more inflation than another, their currency is depreciating, and that exchange rate is not going to be at the target level. Another definition for you, the neutral interest rate. This is the kind of thing where you may only see it once on the exam, but if it is on there, you might as well get the points. The neutral interest rate is the trend growth rate of real GDP plus the target inflation rate. Well, what's neutral about it? Well, that should be the rate that puts you on the target inflation rate. Remember, if the money supply expanded at the same rate as the economy, so if real GDP growth is 3%, and we expand the money at 3%, that would be consistent with zero inflation over the long term. So we've got a little higher target than that. So we're going to take the growth rate of real GDP. So you say, well, the economy's growing, its trend rate is plus 2%. Per year, and our target inflation rate is plus 2%. Well, surely this isn't a complicated calculation, just an illustration of this concept. So in this case, if we grow the money supply at this neutral rate of 4%, then we should expect 2% inflation. So now to look at a policy rate and say, is it contractionary or is it expansionary, we've got to compare it to the neutral rate. So if that policy rate, right, that interbank lending rate or the rate at which the central bank lends reserves is higher than that, well, remember, raise the policy rate, contract the economy. If the policy rate is below this neutral rate, then that's expansionary. So that's the neutral interest rate and how we use it to determine whether a particular monetary policy, as expressed in the policy rate, is contractionary or expansionary. So, earlier we talked about the banking system, the potential, and how this transmission mechanism works. Well, are there reasons why it might not work and limitations on what central banks can do with monetary policy? Well, yes, there are, and let's talk about them now. This first one says long-term rates may move oppositely to short-term rates because inflation expectations change. So in our short-term rates, we have pretty much the short-term inflation expectations, right, according to the Fisher effect. So if we're talking about 90-day T-bills, that's the short rate. And say 20-year Treasury bonds are the long rate. Well, if the central bank, the monetary authorities, expand this money supply in order to drive down this short-term rates, markets may interpret that as printing too much money and rightly assume that over time that's going to translate into higher inflation. So we could have an expansion of the money supply that drives down short-term rates, but at the same time increases that inflation premium and inflation risk premium. So I should say expected inflation and uncertainty about future inflation increases that inflation premium and actually increases long-term rates, which is not going to be stimulating or expansionary to the economy. So there's one limitation. Now, if the monetary tightening is extreme, expectations of recession may make long-term bonds more attractive, decreasing long-term rates. Right? When do you want to own bonds instead of equities? Well, a recession is a good time to own bonds rather than equity, especially if the bonds don't default. And so what we're saying here is that there's an attractiveness to long bonds. So even if they're tightening on the short end, that may bring long-term bond yields down as money shifts into long-term bonds, bidding their prices up and long-term rates down. Well, again, this is just the opposite of what the central bank is trying to do with tightening. This decrease in long-term rates could increase investment spending, and that would run counter to the idea of economic contraction from monetary tightening. Now, this third one here, the liquidity trap is how it was originally named. If demand for money is very elastic, people will hold currency even as the money supply increases, referred to as a liquidity trap, right? We said, well, if they get excess supply of money, people try to get rid of it, they buy securities. Well, in this case, they're not doing that. So that equilibrium mechanism that we talked about that got us from a too low rate back up, or from a too high rate back down, well, this is getting interrupted now because we expand the money supply, and instead of buying interest-bearing securities with this and driving their prices up and yields down, they just hold on to it. That's the liquidity trap, and what it means is expansion of the money supply becomes a less and less effective tool for managing that policy rate. Two more limitations. Banks may desire to increase capital and not increase lending in response to expansionary monetary policy. Well, we've seen this in recent history when banks, after the last financial crisis, the credit crisis, I guess it was called at the time. So, banks, as the policy rate was lowered, they expanded the money supply greatly. There's lots more money out there, but instead of turning around and lending it, right, which is what would support this deposit expansion multiplier and growth in the economy, they decided, well, they didn't have enough equity capital, and they needed to increase that. So they used those funds to increase their equity capital rather than lending them out. And so that's kind of a break in this transmission mechanism as well. And our final limitation here is pretty straightforward. Rates can't be below zero. So it really limits a central bank's ability to act when there is deflation. We've talked a couple of times about how central banks want to avoid deflation, and this is one of the reasons. They can't put these policy rates below zero, right? Once we've lowered them to zero, if we've got deflation, we've got a negative return on that money. So, recently central banks have employed what's been called quantitative easing. I think we're on QE3 as I record this. Buying longer dated government securities, mortgage securities, and risky bonds. So this is a little bit different. The reason we bring up this term here, quantitative easing, is really money supply increase, but they're not doing it with those short-term securities and manipulating the policy rate. They've gone in and bought longer dated government securities, mortgage securities, and even some risky bonds to reduce long-term rates to stimulate the economy. Okay, let's find my pointer here, and maybe I can go to the next slide. Yeah, there we go. Okay, fiscal policy. We wrapped up monetary policy. For now, let's talk about this fiscal policy. Well, this is what we described before. Increase spending or decrease taxes, or both, which increases aggregate demand through G, but also through consumer spending because of the taxes. Contractionary fiscal policy, just the opposite, decrease government spending or increase taxes, or both, and decrease aggregate demand. So you remember when we talked about business cycles and how the Keynesian solution was to step in and change aggregate demand because of the downward sticky wages under Keynesians and wages and other input prices under the new Keynesians. So these are the two tools. We talked about how monetary policy affects aggregate demand. Well, now we're going to look at the fiscal policy, how that affects aggregate demand, and how it could, in theory, be used to counter economic cycles. So these Keynesian economists believe discretionary fiscal policy can stabilize the economy, increase aggregate demand, shift that aggregate demand when we have recessions, and decrease it to combat inflation when we are at over full employment, to the right of potential GDP long-run aggregate supply. Now, there are automatic counter-cyclical stabilizers. Taxes and transfer payments tend to decrease deficits during recessions, right? Recessions, increase deficits during recessions, decrease deficits during expansions. So, we're in an overheated economy. Think of unemployment insurance. When we're above full employment, payments for unemployment insurance are low. Nothing has to be enacted, nothing has to be changed. This is just the way it works. If we're in a recession, unemployment is high, then this government spending for unemployment insurance increases. So that's why we call these automatic stabilizers. They're already in place. They don't require a new policy decision. They don't require an act of Congress or anything. They tend to automatically stabilize the economy. And that's also true of progressive tax system. When incomes are down, taxes are down more. When incomes are up, taxes are up more. So these are both just automatically in place, kind of fiscal policy things, but they don't require any legislation or a new policy decision to stabilize the economy through business cycles. So the fiscal policy objective is to influence aggregate demand and economic growth. Also, there's redistribution of wealth through welfare payments, unemployment payments, retirement payments from a government-run Social Security system, and also to affect the allocation of resources to different sectors of the economy. And that's where governments really get wild and start mandating that I put ethanol in my car and subsidizing the production of ethanol. They want to affect the allocation of resources there. So these are the three uses of fiscal policy. And as you might suspect, it's often political. So what are the tools they use? Well, one is transfer payments, cash payments by the government to redistribute wealth. Current spending, government purchases of goods and services, whether it's for the military or any other operations of the government. And capital spending increases future productivity. So if they're spending on infrastructure, developing ports, roads, research and development on new technologies. Think of this as investment spending by the government, and their current spending being more of a consumption type expenditure. Now, on the other side, the revenue side, we've got direct taxes. They take time to implement. It's got to be passed through the Congress or the Parliament, some sort of legislative body usually. But it takes time to implement. So it takes time to increase income taxes, but the effect is pretty direct on the economy. When taxes go up, disposable incomes go down. Disposable incomes are what drive consumption spending to a large extent. Now, indirect taxes, it's easier to change those to raise some revenue or promote a social goal. The example here is given as tobacco tax, but these indirect taxes, sales taxes, value-added taxes, that translate into final goods prices to consumers are going to have an effect on their spending as well. Tobacco tax raises the price of tobacco by $1 a pack, supposedly people buy less tobacco. It would depend on the elasticity of demand. So, we had the potential multiplier for the banking system. Now we're going to talk about a fiscal multiplier. The idea of this fiscal multiplier is if the government goes out and they say, okay, we're going to build a new army base in this region. So they're spending money. They're hiring construction workers. They're buying construction supplies. They've got paying their workers. That now their workers are going out and spending this money at the businesses in the community. That puts more money in those businesses and they spend that money. So this is the idea of the multiplier effect, or the fiscal multiplier effect, that $1 of government spending actually has a larger effect on overall GDP. Now, we've got a formula here, okay? But let's check our learning outcome statement here. I guess we're on O already. Okay. Okay, so I don't think there's any calculation. You're supposed to understand the fiscal multiplier, but what you need to understand is how this MPC and the tax rate affect this multiplier. Well, the MPC, that's the marginal propensity to consume. It's the percentage of a dollar that gets spent. Remember, dollars taken in by workers are either spent on consumption, saved, or paid to the government as taxes. So that's why we've got this in here. We want to capture how much gets spent out of each dollar once we take out savings and once we take out taxes. So that's what's going on here. That's why we've got this marginal propensity to consume here. When that is higher, less is saved. So an increase in this marginal propensity to consume is going to increase this multiplier. Makes the denominator smaller. Now what about taxes? Well, an increase in taxes reduces the multiplier. We're multiplying times 1 minus taxes. So if the tax rate goes from 30% to 40%, this piece here goes from 0.7 down to 0.6. That reduces this overall term, and that increases the fiscal multiplier. So rather than worry about that exact formula, I want you to understand that it's all about spending. And the higher the tax rate, the less there is to spend, the smaller the multiplier. The higher is the marginal propensity to consume, the percentage spent out of each dollar of additional income, the greater the multiplier effect. Now, sometimes you'll run into, rather than the marginal propensity to consume, sometimes you'll run into the marginal propensity to save. And that's just the reciprocal of that. So the marginal propensity to consume is 0.84. The marginal propensity to save is 0.16. So an increase in the marginal propensity to save decreases the marginal propensity to consume, and that's going to reduce the multiplier. So, a simple example here for a marginal propensity to consume of 0.8 and tax rate of 0.3, $100 billion spending increase over time, because it takes time for this money to flow through all those hands I talked about, can increase consumption by this fiscal multiplier. And so here that fiscal multiplier is looking a lot like 2.27, because $100 billion in direct federal spending is having this multiplier effect of, over time, increasing economic activity, GDP, by 227 billion. Well, if we've got a fiscal spending multiplier, we've also got a tax multiplier. Now, the tax multiplier is going to act just oppositely, right? Taxes go up, people have less disposable income. They spend less, that decreases the incomes of the butcher and baker and candlestick maker, and that's going to have a multiplier effect as well. Now, it starts out a little smaller, though, because with government spending of $100 million, that went straight into, or $100 billion, I guess it was, that went straight into the economy as spending. Now, if we increased taxes of $100 billion, that would reduce consumption by 80% of that. Because our marginal propensity to consume, we said, was 0.8. So if we take $100 billion more in taxes, this reduces consumption by 80 billion. And then over time, we get this similar multiplier effect, leads to a decrease in consumption spending of 182 billion. Okay. So the 100 billion spending by the government for our fiscal tax our fiscal multiplier, fiscal spending multiplier, was an injection of 100 million directly into spending. If we increase taxes to offset this spending by 100 billion, the decrease in spending is only 80. So we say that the balanced budget multiplier is positive. Balanced budget meaning we increased taxes by 100 billion and we increased spending. So it was so-called revenue neutral, didn't affect the deficit. And yet it still has a positive effect on the economy. The reason being is that this tax multiplier is smaller than the spending multiplier. That's why we say the balanced budget multiplier is positive. So, using those same numbers we had, 100 billion increase in spending, 100 billion increase in taxes, so-called revenue neutral, over time this could increase consumption spending by the difference between that 182 and the 227. Again, the balanced budget multiplier is positive.